Not too sure how the tax code even works? Well, don't feel bad. You're not alone. It's a big, complicated topic. I'm going to boil it down to the bare essentials for you today. So basically, the U.S. has a number of types of taxes. Today we're just talking about the income tax. That's what we deal with here at Granite Point Tax Group. My name is Matt Bannon, and let's get into it. So the U.S. taxes income and defines income as anything that puts you into a better financial position, whether that's money received for goods or services rendered, or debts forgiven, pretty much anything that makes you financially better is considered income, and there's a tax on that. So the U.S. has what's called a voluntary tax system. That does not mean that you get to choose whether or not to pay it, or that you get to choose whether or not to file tax returns. What it means is it's up to you to tell the government how much your tax is each year. They have the right to come in and audit and make sure that you calculated that correctly. But generally, everybody every year calculates their own tax and makes sure they're paid in. The way we do that is with a big complicated set of rules that talk about what is income, what kind of deductions are we going to allow against that income, and then finally the tax tables that calculate the actual tax itself. So we start off with our tax form 1040. That's the individual income tax form. There's a shortened version, a 1040A. There's an even more shortened version, a 1040EZ. But everybody can file on a 1040 if they want to. That's the full form that covers everyone. So you start out with your name, your spouse's name, if applicable, any dependents that you are claiming for taxes, which we'll get into in just a second. And then it asks about all your types of income: wages, interest, dividends, business income, rental income, farm income, pension income, IRA distributions, Social Security, you name it. It's got a line for it. And if it doesn't fit on one of the lines, then if it's on the last line, other income. That's where you would put cancellation of debt and other things, so it doesn't specifically list on the 1040. Then against that income, after you add all that up, you get certain adjustments against that. They're called. If you put money in a traditional IRA, you may be able to subtract that from your income. If you pay alimony to an ex-spouse, you can deduct that from your income. If you have a child in college, you may be able to deduct a portion of their tuition from your income, and a bunch of other stuff. So you subtract all those, and then that gives you what's called your adjusted gross income. That's a number that bankers are especially interested when you're looking at a mortgage or a refinance. They always want to know what your AGI is. That's what it is. After that, everybody gets a deduction in addition to the ones we just talked about, the standard deduction, or you may, if you have certain deductions like a mortgage or large medical expenses or large charitable contributions, you can deduct those in lieu of your standard deduction, but you have to list them out or itemize them. So you have your standard deduction or itemized deductions. So you subtract that from your AGI. Then after that, you get each person has a personal exemption, so another subtraction from income. One for you, one for your spouse if applicable, one for each dependent you're claiming on your tax return. There's a whole big set of rules about who you can and cannot claim as a dependent, so we'll probably do a different video on that. It's complicated. But it basically comes from page 1, how many did you list? multiply that by personal exemption amount for the year, subtract all that, now you have what your taxable income was for the year. So then you go to the tax tables and look up your amount and your filing status: single, married filing jointly, married filing separately, head of household, qualifying widower, whole other set of rules. And just look up how much your tax is. Now the U.S. has what's called a progressive tax system. That means that the higher your income is, the larger percentage of it the government is going to take in the tax, in the form of taxes. So if your total taxable income is only $10,000, you probably will not owe any income tax. You'll be in a 0% bracket. As your income climbs, you'll work your way up through the tax brackets. And so let's say you have $400,000 of taxable income. You're going to pay each tax bracket and max out at the top tax bracket of 35% currently. So then you calculate tax. There could be some other taxes due, alternative minimum tax, self-employment tax. If you are a business person, no one is withholding Social Security taxes from you, so you are on the hook for that on your own. That comes into play in your tax return. There could be a 10% early distribution penalty if you took an IRA or pension before you reach retirement age. That could come into play. Household employment taxes if you have a nanny or landscapers or anything as an actual employee at the house, not not just a daycare provider or a gardener that comes in once a week. That wouldn't be the same. So anyway, you add up all those taxes. You're allowed certain credits against your tax. If you have daycare expenses, children as dependents under the age of 17, foreign taxes paid, various credits, those will reduce your tax owed. So you add up all your tax owed and then figure out, okay, how much have I paid in for the year? That was what I owe for the year, and how much have I paid? If you're an employee, taxes have been withheld from your salary throughout the year and forwarded to the government on your behalf. If you're not an employee, you may have paid quarterly estimated tax payments. You may have applied some or all of last year's refund towards this year's taxes. And there are some tax credits that act as money paid in. Earned income credit, additional child tax credit, a couple others. Those are going to act as money you have paid in for the year. You add all that up. You got your tax amount, the amount you've paid in. The difference is what you owe the government, or the government owes you. So at after the end of each year, by April 15, the IRS would like to know, at the very least, how much do you owe them, how much do they owe you. You can get an extension to file the actual tax forms if you need it, but they want the money by April 15. After that, they're going to charge you interest. So by October 15, if you're on extension, you need to actually send in the forms. So you mail in the tax forms that show how much your income was, what kind of deductions you had, how much you owe them or they owe you, and then if they owe you, they send you a check. If you owe them, you send them a check, and you're done. Do it again next year. Thanks.